Should you rent where you want to live and invest elsewhere, or just buy your own home? This is the million dollar question that confuses so many Australians. Today, we are not just answering that question, we are breaking down the numbers. We are going to compare buying a $1 million home with renting a similar property and show you a strategy that could build wealth faster. So, welcome to your Rentvesting Masterclass. And before we jump in, a quick but important disclaimer. Now, here's what we will be covering today. First, we will define what rent vesting is and break down its benefits and cons. Then we will dive into a real life case study comparing the cost of owning a PPOR versus renting. We will show you exactly how the numbers work and answer the $1 million question about capital growth. Finally, we will share some pro insights to help you decide if this is the right strategy for you. Feel free to use the timestamps in the description to jump to any section that interests you most. So, what exactly is rent vesting? It's a strategy where you rent a home that suits your lifestyle while simultaneously purchasing an investment property in a different, more affordable area. You get to live where you want. While your money works for you somewhere else, it's about separating your lifestyle from your investment portfolio. Now, first, let's dive into the benefits. First is lifestyle flexibility. You can live in a suburb you might not be able to afford to buy in. Second, leverage investing. You can buy in growth areas that offer a better rental yield and stronger capital growth potential. Third, tax benefits. As an investor, you can deduct expenses like mortgage interest, maintenance, and depreciation, which isn't possible with an owner-occupier home loan. Fourth, diversification. The money you save can be used to purchase multiple properties, not just one. And finally, mobility. If your job or life circumstances change, you can easily move out without being tied down by your own home. But of course, rent vesting isn't perfect. So let's look at the downsides. You have a lack of security in your own home. Your landlord can increase the rent or even end your lease. Some people feel an emotional disconnect because they value the stability and the pride of owning their own home. You also miss out on the CGT, which is the capital gains tax exemption that applies only to the primary residence. And your expenses may increase if you have to manage a negatively geared investment. And finally, there are no forced savings. Unlike a PPOR mortgage, which forces you to pay principal, you need the discipline to invest the money you save by renting. Now, let's put real numbers to this whole scenario. We are going to compare the upfront and ongoing cost of a $1 million PPOR versus renting a similar property. Now, to buy a $1 million home with a 20% down payment, you will need about $200K upfront. You will also pay around $35,000 in stamp duty and other fees like conveyancing and bank fees. The total upfront cost, including everything, is around $237,000, which is a massive amount to save. And for renting, you can rent a similar property for around $1,000 per week. That means your upfront cost is just the rental bond, which is typically 4 weeks of rent. That makes it around $4,000. Now, for the ongoing cost, a $1 million owner occupier with 800K loan at 5.5% interest over 30 years will cost you around $54,000 a year. And that is just the mortgage payments. On top of that, you will have land rates, insurance, and maintenance cost, which takes your total annual cost for owning over $64,000. Compare that to renting a same home for $1,000 a week, which is a flat $52,000 a year. And that's it. No rates, no maintenance, no insurance, just pure rent. The difference is significant. Now, the $1 million question. What do you do with that savings? The true comparison isn't just rent versus mortgage, but what you do with the difference. Instead of putting all of your money into one PPOR, you can use the savings to build an investment portfolio. Let's say you take that $237,000 you would have spent upfront and bought 2 investment properties instead. The presentation shows 2 properties worth 1.2 million combined. The upfront cost, including down payments, stamp duty, and fees, would be approximately $207,000. Remember, for investment properties, we are not going through with the 80% LVR. Now, the total Ongoing outgoings for these two properties, including mortgage repayments, insurance, maintenance, and management fees, are around $70,000 per annum. But these are offset by the rental income of $57,000. And you also get tax benefits of roughly around $4,000 to $6,000 per annum. And you are building a portfolio of tax effective investments. Now, up on the screen are the long term projections. So, what we find is that this is the mic drop moment. Let's look at the long term growth. On the home ownership path, your $1,000,000 primary base of residence growing at 5% annually would be worth around $1.63 million after 10 years. All your eggs in one basket. Over that decade, you would have paid over $500,000 in interest to the bank. On the rent vesting path, you are still renting your lifestyle home, but you have bought two investment properties, and if they also go at the same 5% annually, they would be worth a combined $1.95 million after 10 years. You would have also received $572,000 in rental income and used tax offsets along the way, helping you to cover your cost even more. Your rental income is also likely to increase over those 10 years that we have not factored in. And remember, renting the lifestyle home doesn't stop you from building a portfolio of tax effective investments. So, what's the takeaway? Renting isn't dead money, it's paying for lifestyle flexibility. Renting doesn't mean you are throwing money away, you are paying for lifestyle flexibility while building wealth elsewhere. The real question isn't just a rent versus mortgage, but what you do with the difference. This strategy also gives you the benefit of living closer to the premium locations like CBD, beaches, or good schools while your investment works in the background. Now, second $1,000,000 question, what about the capital growth on PPOR, which we have already answered in the example above? The real power of rent investing lies in the opportunity cost. The money that would have been tied up in a huge mortgage for a luxury PPOR can be strategically invested to build a property portfolio. Key is to be disciplined, to use the saved money while renting to buy investment properties that are increasing in value in the growth areas. Now, rent vesting isn't for everyone, but for the right person, it can be a game changer. It depends on your goals, income, and financial discipline. If you want to explore if this strategy makes sense for your situation, feel free to reach out. We would be happy to run the numbers and create a strategy that works for you and helps you achieve your goal and your desired passive income. And I hope this video helped in giving you some clarity on rent vesting. If yes, please like, subscribe, and share with a fellow investor. And do comment what other topics you would like to be covered.